Guys, Naeem Al-Obeidi here, and I am with Charles Hoskinson and Colin Edwards today. Charles is a mathematician, co-founder of Ethereum, the founder of Cardano, which are two of the world's most popular cryptocurrency networks, and Colin Edwards is the lead quant at IOHK, which is also one of Charles's projects. And it is a pleasure to have you guys on. Thank you, guys.
Thanks. Thank you so much for having us on, Naeem. How's warm, sunny Dubai?
Dubai is doing very well. Bitcoin hitting new all-time highs. I'm here with the Moon Carl and some of the other crypto YouTubers. We like to stay together because we believe in collaboration over competition. And I just want to dive straight into the juice and the meat of this interview here. And I want to talk about the recent new all-time high with Bitcoin breaking 22,000 US dollars, and massive institutions like MicroStrategy and Mass Mutual being very vocal about them investing into Bitcoin, along with the launch of CME futures coming in February for Ethereum. The question I have for you, Charles and Colin, being the lead quant, Colin, definitely chime in here. How do you guys believe large institutional funds will allocate capital outside of Bitcoin and Ethereum moving forward?
Well, I think that when we look at the capital in there, I think that the crypto industry is going through a period of looking at different market segmentation, and most investors are going to be looking for some kinds of diversification. So they're not as linked to one platform, while they are in many ways enjoying much of the growth in cryptocurrencies. Being too involved with a single platform, of course, concentrates your risk. So I think that you're going to be starting to see more widespread adoption, particularly as these platforms start really showing their true potential and becoming full smart contract platforms and getting better market segmentation. So there's going to be platforms that focus on media, platforms that focus on payments, and that kind of environment growing up is going to be something I think that people are going to want to hold a lot of different coins going forward.
Yeah, and actually, one of the things that I've noticed in the markets, and Colin can certainly jump in on this, is that the sophistication of trading and financial products in crypto, because of the nature of the actors that are coming in, has changed considerably. You know, when I was first in crypto, we traded on spreadsheets over forums and used PayPal to pay each other against the EOLA. It was a very long time ago, but actually it was only less than 10 years ago. And now you have these, you know, 7-figure, 8-figure, 9-figure, sometimes even larger deals that come in where people buy hundreds of millions of dollars worth of crypto. You can't just go do that by creating a Binance account and doing market orders, right? You need very sophisticated technology and tools and order routing and financial products. And then it requires the creation of derivatives markets and so forth. And actually, Colin spent the last, what has it been, about 6 months now, analyzing the markets. You know, what are some of the things you've learned from that analysis?
Well, I think that the markets are still highly correlated. I mean, Bitcoin is certainly the big player. I mean, the tide that lifts all ships, I guess. And so, you know, that Bitcoin news is really good news for everybody, I think, in the crypto world. But I think that beyond that, you start to see coins starting to show some individuality and breaking out. I think certain things that we've done at IOHK, like the delivery of Shelley, was certainly a big market event, moved us to a new level versus Bitcoin. And those kinds of events of delivery and actually showing value are really pretty important as well. So I think that while the markets are very correlated, you're also seeing opportunities for coins to really come into their own as well, so that it's kind of an exciting time. It feels like the very start of a market, you know, as it grows up. You know, it's coming out of an infancy, and you know, there is, how do we deal with regulation? How do we deal with the other challenges? But at the same time, I think that it's really great because we're starting to see coins start to differentiate themselves and carve out their own niches.
Yeah, and that's a great example between 2017 and 2020, because 2017 was the last time that we reached the all-time high. And you always ask, like, how is the market different? The numbers are numerically somewhat similar, but it's kind of looking at like Amazon 2000 versus Amazon 2011. You know, it took until 2011 for Amazon to recover its all-time high, but it was materially a very different company in 2011. And so there was a real justification behind that value, whereas the value in 2000 was phantom value in many senses. So what's nice about seeing a decorrelation or a decoupling from Bitcoin being a rising tides effect and everything just blindly follows, and event-driven things are starting to influence price, is telling you that you're less technical and more fundamental now with trading. People are actually looking for long-term growth, long-term value. They're asking for different KPIs other than just looking at a chart and saying, oh, that triangle looks promising. Let's go chase that for a little bit and see if I can get some delta. That always makes me happy to see that fundamentals actually matter and you can decorrelate and decouple. The other macro trend that we've noticed is institutional investors in particular believe within the next 3 years there's going to be a massive movement of value from proof of work coins into proof of stake coins. So right now, vast majority of the value in cryptocurrency land is captured by proof of work coins. And it's probably not going to be the case in the next 24 to 36 months. There's going to be a reallocation into things like Cardano and EOS and Tezos and Algorand and F2 and so forth. And they tend to do that on a portfolio basis. So instead of just picking a single token, they create an index or a collection of a portfolio and say, okay, we'll balance it accordingly. And that's really nice. It's going to create a lot more stability in the markets. And we should hopefully be able to have not only a growth of the overall market capitalization of all cryptocurrencies, but also a reduction in volatility. So we don't see these crazy 50%, 100% days, way up, way down. It's great for options traders, but God, it's miserable for, regular everyday people. It's too stressful.
I would say, Charles, it's only good for half of the option traders.
Yeah, those potential short sellers are having a great day, aren't they?
And Traders Profit Club, we've topped almost the most amount of people, cryptocurrency trading. We're one of the largest cryptocurrency trading educational platforms. And what I teach is fundamentals is 10%, technicals is also 10%, and they're equally as important. And then 80% of it is emotional. Now, I want to talk a little bit about what you're, going into when it comes to use cases, because I want you to describe a commercial and financial use case compared to one primarily focused on economic identity in the developing world. Are there any examples that do both, not just economic identity, but also incorporating commercial and financial use case?
Yeah, that's a good question. I think you have to think in terms of foundations. And so first off, we have the DeFi revolution, and this is one of those cart before the horse things. So everybody gets very excited about peer-to-peer insurance and lending, and they get excited about peer-to-peer money. And you start asking yourself, well, hang on a second here, who's actually going to use that? Is it going to be people in the Western world with highly regulated markets and well-established incumbents and low transaction fees? Or is it going to be people who have no financial system whatsoever? And so the reality is you need to create baseline infrastructure, whether it be internet infrastructure, identity infrastructure, regulatory infrastructure, to be able to actually bring in developing world customers. But once they come in, they're far more likely to consume a DeFi financial service than they are a legacy financial service, because there's just so much lower cost for them and it's intrinsically global. So we look at them much the same as a spectrum. And so a lot of our business development outside of the Western world is focused in places like Ethiopia or let's say Nigeria, South Africa, these places where 70% of your population's at or under the age of 30, they're internet enabled, they're desperate for new financial system, and there's gargantuan international investment and pressure for them to change their systems. China, for example, has put over $1 trillion of value into the African continent in the last 10 years. And companies like Huawei are running around giving away millions of tablets and laptops because they understand that this is going to be the fastest growing collection of economies over the next 20 years or 30 years. So the point of economic identity is saying, make sure that your infrastructure is there. Because the minute you give them identity, you've given them a wallet, you've given them a blockchain backend, and now you've given them access to a dApp portfolio. And that's like baseline infrastructure. And once that's there, then you can start putting real commercialization on top of that. And there's kind of three directions you can go. You can go with the everyday retail people, and those are just consumer services. That's like a B2C play. And that's like stable coins and insurance and lending and all the usual suspects, but done with much larger scale because there's so many more customers there. Two, you can do business to business. And usually in those cases, you're taking very antiquated business models that are desperate to upgrade because they're losing market access. For example, in Ethiopia, they're one of the largest coffee suppliers in the world. When Starbucks wakes up and says, no, we only got to buy fair trade coffee and environmentally sustainable coffee, how the hell do you prove that if your production line is like putting bags of coffee on the back of a donkey? and kind of riding it to a washing station. You're like, how do you actually prove to Starbucks you're following sustainable practices and paying people properly? So they're in the market for completely new systems, and it's not optional. If they don't upgrade the system, Starbucks will just simply stop buying their coffee and go buy Colombian coffee or Indonesian coffee or something else. So there's a huge amount of direct foreign investment, international interest, and national interest into upgrading these systems. And there you can leapfrog everybody, much like what Pakistan did with phones. Instead of going to copper, they went straight to 4G, and you put a blockchain system in that's end to end. So when it's there, it's not just for the goods. The identifier component also is for the users, and now they have wallets. Now they have a payment system. Now they have an identity system, all these types of things. And finally, there's government upgrades, where the governments just simply want to restore legitimacy. So how do you know you really won the election? How do you know you really own the land? How do you know that your passport is right? Well, they're upgrading all of these things. In many cases, they actually have direct foreign investment or things like the World Bank or reconstruction banks or whatever, giving them money to actually upgrade their things and modernize their things. And there we have conversations all the time at the president level or the prime minister level, specifically about how do we build an identity system for your entire country or a property registration system for your entire country. And again, that's blockchain based. So some of them are just foundational, like how do you get internet to people and how do you get identity to people? And some of them are, once that's present, then how do you build a model where you actually have a sustainable end-to-end market that can develop from it? And almost all these deals are public-private partnerships in some way, spread the wealth around. And they take about 3 to 7 years to actually realize from start to finish. And so we've been in Ethiopia for about 3 years now. And actually, we're probably going to make a major announcement here in a little bit with an Africa special episode. Yay, South Park, Christmas special. We got an Africa special. So we're probably going to do an announcement at some point about not only what we've done in Ethiopia, a very large scale deal, but also the whole continental strategy and how we're going to leverage that and grow. But it's very long term in that respect. And that's just Africa, and that's the developing world. And I think the next 10, 20 years, that's where everything's at. But in the immediate, it's a question of, well, can we compete with the incumbents in the market for the things that the markets are doing? And the advantage of Cardano is we're just better, faster, and cheaper. We designed Ouroboros over a 5-year period. And when you look at the crop of proof-of-stake algorithms, whether it be Polkadot, which is actually a variant of our algorithm, Ouroboros Praos, or be EOS or Tezos or F2, we think we're best in class. You don't, for example, with staking, need to bond or slash or lock your money up, and yet it still functions. We have a beautiful path to high scalability in the network, where our backbone is based on 91 academic papers. We've written over 1 million lines of code, and the network continues to grow faster than any other by every metric. In fact, tomorrow we're going to have an episode recapping the entire year, and the episode's all about just growth metrics of how many new wallets, how many transactions have happened. It's not just price appreciation, it's population, hundreds of thousands of downloads of Daedalus, our primary wallet. So we're definitely kicking ass on all those metrics. In fact, on decentralization, we have 1,200 stake pools. We're over 100 times more decentralized than Bitcoin in that respect. And actually, Colin does some of the modeling for the economic parameters there. It's extraordinary to see it go from papers we wrote at Oxford to actually doing what we thought it was going to do in real life. And the next year, we're rolling out all these beautiful smart contract strategies, which will allow us to actually service a huge commercial pipeline. We already have 110 companies that have come to us to ask us to do something on Cardano, and we just don't have the resources or time to service that entire deal pipeline. So we're trying to prioritize deals and give deals away and so forth, just because there's so much commercial adoption and potential that we have for the platform. So it's nice to be in a rising tides. It's nice to be in a high growth industry. It's nice to be the tech leader. And it's nice to be the fastest developer. We actually are #1 for GitHub commits every week. And we're deploying software on a weekly basis now in a very agile way. So we're speeding up, and our competitors are slowing down because they're getting mired in complexity. And they don't really have a plan for how do they go from 1 million users to 10 million to 100 million. Whereas the way we built our technology, it very organically can scale in that direction. And right when we need it is when we bring Africa online, and that's what's going to get us 1 billion users in the system over a 10-year period.
I did see that Cardano is the most committed project on GitHub. Being an analyst, of course, I check those things even more than Bitcoin on a weekly basis, which is quite amazing. And I do respect that highly. As a mathematician, of course, it's great that you're vocal about things. And I wanted to mention Polkadot because we actually have a question from my Discord, from one of our members in our Discord, from Jay Bird. He says, how do you see yourself in 5 years referring to Cardano, compared to Ethereum and Polkadot. Where do you see Cardano in 5 years in comparison to Ethereum and Polkadot?
Yeah, we're all of the above, and what they've chosen to do is just focus usually on one or two things. And so way back in 2015, I said, guys, third generation blockchain, the one that goes from toy to useful for everybody, it has to have three foundational capabilities: scalability, interoperability, and sustainability. And the problem with Ethereum too is that they only do part of that domain. So there are a lot of things they've done for great interoperability, and obviously Casper, the way they've designed it, if they can get it working, is quite scalable. There's no governance system though. And the problem is that the bigger you get, the harder it is to change things. And the Bitcoin people say that's a feature, not a bug. And if you're a single-use application like digital gold, it makes a lot of sense. But if you want to do things like be the world computer or world financial operating system, or deal with complex and very serpentine regulation, you're going to have to change often. You're going to be a lot of hard forks. You're going to be adding a lot of new capabilities to the system. And if you have 10 million people, no governance layer, then either you just descend to a centralized dictatorship with a single foundation being in charge of all of it, or you descend to what Bitcoin has, where you just can't change it all. So what we did is we said, not only are we going to lead in scalability and interoperability, and we have a big protocol lead on everybody because we wrote so many scientific papers, we kind of know what the whole design space looks like. But then we also actually invested extremely heavily in governance for over a 4-year period. We wrote a lot of academic papers, and then we launched one of the largest DAOs in the world, Catalyst, which is right now running, and that treasury system will give away at least an $80 million a year to community-led projects with high participation amongst ADA holders. And I think over 63.4% of our network is staked. And so we should actually start seeing voting turnout of relative proportions, which is incredible. And it dynamically scales the system. Then you can also use that same governance layer with a project we built with the European Union through a Horizons 2020 grant with IBM and Guard Time to actually update the system. We have something called the Hard Fork Combinator, and we designed an update system to combine these things together so that basically people can vote to upgrade the system. So we have a very clear governance advantage of how to pay for things, long-term and short-term, across the spectrum, whether it be marketing things or development things. And Ethereum doesn't have that, and Polkadot really doesn't have that, nor does EOS or Tezos. And we have a very clear system to upgrade the system. And that upgrade mechanism, the only competitor we have there is really Tezos in that respect. And I think that it was very wise for them to go down that road. So from comparability, it makes a lot of sense. The other thing is that we have a research capacity that dwarfs all of our other competitors. What they tend to do is they tend to all talk to each other at the conferences and say, this is the protocol we should use, and they go and play around with it for a few years until it doesn't work. We're playing three-dimensional chess. It's like we actually understand all the design space. We write systematic papers covering proof of work and BFT algorithms and proof of stake algorithms. And at any given time, we understand the state of the art in all these fields. And we also understand what they can do and what they can't do. And we also understand how to integrate them into other disciplines that are absolutely required. Like, for example, network stacks. No one ever talks about this, but how do you build a network layer that when you get to 1 billion users, you're not going to have massive latency and everything slows down? Like, how do you keep up with a network that has 1 billion transactions a day if you have to download all those transactions? Bitcoin, Ethereum, One, all these are replicated systems. So you're only secure if everybody can do everything. So you're only as fast as your slowest user in that respect. So you have to move to a distributed system, but when you do that, then all of a sudden you have a hierarchy of users in the system, and then how do you sort all these things out? So then what they do is they say, oh, we'll solve the problem through like really bizarre technology like recursive snark this and insert crypto term here like MPC or whatever. And that's great for one thing, but you need a holistic solution or else you break your protocol. So that's a huge advantage we have in like 3 to 5 years, is as we go from 1 million to 10 million to 100 million users, our competitors aren't built in a way to sustain that. And they're going to run up against walls, and they just simply don't have the research bandwidth to be able to overcome those walls, because those problems are exponentially more complex than the problems of bringing an Ethereum to market or bringing a Bitcoin to market. Whereas the way we designed everything, from our network stack inspired by Arena to the way we did the accounting system with extended UTXO, all of these things were built in a way that it's very easy to shard, and you kind of really understand how to do things off-chain and on-chain. When you need to roll things up, it's very clear how that's done. And we all have beautiful security proofs for the entire stack. So we understand how to do composition. to add things into the system. And we know when we add it, if it's going to break it or not. Whereas these other guys are just kind of guessing. It works until it doesn't. You can't build a world financial system that way. It's chaos.
And with the popularity of DeFi, to piggyback off of that, Miguel asked, what will be the first DeFi companies to launch with Cardano, or the first to come out with audited protocols all ready to go like Ethereum?
Yeah, so there's something we term commercially critical Cardano infrastructure, the CCCI, and you kind of need that to catch up and be on par with the incumbents in the market. So there you kind of have 6 things. You really need a good DEX solution, a good Oracle solution, a good stablecoin solution, You need a really good identity system, and you need a really good state channel system. Okay, so those are kind of the core 5. And then I kind of give 6 as a catch-all category because there's always some other favorite application that somebody involved. But those core 5 bare minimum are foundational. In addition to having a stable, low-cost, reliable ledger, you kind of need those things to be able to build applications in your system. And what I usually term number 6 is your off-chain infrastructure. So like Ethereum has Infura and these things. You kind of need that because a large chunk of your dApp is not going to live on the blockchain. So we have a stablecoin project that we've been doing. We have an Oracle project that we're working on with some partners. We're actually going to make an announcement about that probably tomorrow. And we have a partner that we're going to build a DEX with that we think is quite competent. And we have Hydra for our state channel play for off-chain microtransactions and so forth. And we have Prism for our identity system. And Prism's being tested by governments like the country of Georgia and country of Ethiopia, and we'll eventually test the scale of millions of people. And we're also building a companion product called Mirror that handles KYC and AML. So you can do authenticated transactions and accounts. So if, for example, the US government changes regulations and says you now need to associate identity with wallets, it's going to be a very easy way of doing that with Cardano, which is much harder to do in a lot of our competitors. But all of that baseline infrastructure is reusable by apps built in our system, along with base stuff like the native asset standard that we have. When you issue a token on Cardano, that token's treated the same way as ADA. When you issue a token on Ethereum, it's not. It's treated differently. It's a smart contract versus the Ether. So they have very different dynamics. And one of the advantages of having a first-class citizen native asset standard is that eventually you can even pay transaction fees in that native asset. So if you have a very large token like a Chainlink that has a lot of value, through using the governance system, you can actually make it so that the state pool operators accept payment and transaction fees in the native token as opposed to the ADA. What's great there is that means like you have your own blockchain effectively, but you don't have to actually run it or any of these things. So these are just native advantages that we have, and there's a lot of sharding and scalability advantages that the accounting model has. The other thing is that governance system I mentioned, Catalyst, which gives away 80 million a year grants and also allows you to do hard forks. That governance system is reusable for any token issued on Cardano. We have a roadmap for that. So when you talk about the governance of DeFi, who's in charge, how do you upgrade, like MakerDAO's trying to DAOify themselves right now because they don't like class action lawsuits and these things. So they're trying to figure that out. Well, at some point, when you issue a token on our system, in addition to using all that baseline infrastructure, you'll be able also to use our governance stack to have votes from your token holders, and you don't have to build your own governance stack. So having those modules plugged in is something that allows you to hit the road quickly. As a final point, we also recognize that there is an incumbency advantage with Ethereum at the moment. It's small, but it's certainly there. And so we have something called the DevNets, and they're going to turn into permanent sidechains in Cardano. We're launching the first one tomorrow, and we'll have full Ethereum interoperability. So we're running an Ethereum virtual machine because we built Ethereum Classic. We're really good at this stuff. We kind of know how the EVM works. We spent 3 years playing with it. We're also, with runtime verification, the first firm to actually write the first set of formal semantics with Ethereum. So effectively, we're Ethereum core developers. We understand that technology really well. So we just basically built a sidechain to run Ethereum smart contracts. So starting tomorrow, if you have an Ethereum project, you can port it to Cardano and start playing on it with the DevNet and just take your Solidity code or your EVM bytecode and you can run it one-to-one with no modification. And I think we'll even have truffle support and all these other things. And that'll become a permanent sidechain of Cardano. So you can either write it in native assets with Plutus and Marlowe. It's a beautiful experience. Or you can write it with your traditional tools with Ether, but it's just better, faster, and cheaper on that sidechain than it is in Eth1. So, I think we bring a very compelling development strategy, a little bit of new stuff, a lot of old stuff, and just better, faster, and cheaper. And especially with Plutus, we'll have resource determinism there. So, those weird gas economics of these things, it's going to be a lot easier. In fact, that's another thing Colin's working on. I think you're thinking about the gas model for Plutus.
That's wonderful. And so to piggyback off of that, you're talking about the great technology and the infrastructure that Cardano has. A question from Mandrick says, what industries have shown the most interest in the adoption of Cardano? What does it mean for consumers and competitors of those industries if that adoption started to take place?
So where we've seen a lot of interest is in track and trace projects like Beef Chain, for example. There are 1,600 cows right now on our blockchain. It's pretty easy to scale that. People say, oh, who cares about that? Well, actually tracking, tracing meat is a big deal in the world. I mean, just proving things are kosher halal is a huge deal. It's like so much you have to prove about stuff, right? And so we've seen a lot of interest there. We've seen a lot of interest in the identity side with Prism's proliferation and growth. And we've gotten a lot of offers. Like we have the ERC20 converter. So it's a special framework to allow people to migrate from Ethereum to Cardano. And we've gotten a lot of projects like SingularityNet, for example, is moving over, and other people are going multi-chain, and they're using that, like Blondly, for example. So it's a big market, it's a growth market, and it's one of those situations where demand outpaces supply. So it's not a winner's take all where one or two incumbents dominate that market. That's that. It's more of a situation where you're going to see a Cambrian explosion and extinction of applications. So 90% of dApps that are created today or in the last 24 months will not be here in 3 years. So it's going to be the case that everybody has lots of things. That's why it's much more important to ask, what is your user acquisition strategy of populating your network with lots of users? Because the USP of building dApps on our system is there's people who are actually going to use those dApps, and they're quite sticky. And so when you think about DeFi, you say, well, nobody in the Western world needs it, and it's going to be regulated out of existence at some point because banks hate competition. So, really the only place you're going to get meaningful customers from are places like Southeast Asia, Eastern Europe, South America, Central America, and Africa. So, if we enter in with the fact that we have consent deals that we've made with governments and large companies that bring in tens of millions of users, then the USP of building on Cardano is those users are our users or your users. And that marketplace is available to you. So not only do you have to have a great DevX and good dev tools and very easy for developers to build things and a good asset strategy, so that's for developer acquisition, collaboration, and incentives and application deployment, but then you also need to have a good user acquisition strategy.
Could you elaborate on the differing role of cryptocurrencies in general when it comes to developing countries and developed countries? How do they differ? What is the role of crypto and what makes them different?
Yeah, so cryptos do very differently. Like, for example, Africa, they have a currency called M-Pesa. It predates cryptocurrencies. But if you live in a country where your national currency has capital controls and it's highly inflationary, you don't really respect that. And you use alternative currencies. Many, like South America, for example, you go to Argentina, they buy things in pesos, but they immediately convert back to the US dollar through like street vendors and things like that because they don't want to hold the underlying currency because it's just so terrible. Well, similarly, many African nations, people just don't trust their local currencies because look at what happened in Zimbabwe and many other places. And there's bad monetary policy. Like it's really hard, for example, in Ethiopia to move bear out of the country. So you can be paid there, but you have to spend it there. And, capital controls are tough. So crypto makes sense because it's kind of like a political compromise. You have all these entrenched bureaucratic old systems that are slow to change. And unfortunately, because of that, you can't globalize. So the entrepreneurs there and the governments there, they have to have some other mechanism to experiment with. So they're actually quite open to cryptocurrencies, from CBDCs to just using cryptocurrencies to represent commodities like gold-backed stable coins, or creating security token exchanges because they don't have stock markets, and so they just say, screw it, instead of building a normal stock market, let's just build an STO exchange, these types of things. And so there's a lot of innovation that exists in those markets, and the regulator and the government is actually working with you because they need this to exist for economic benefit. Contrasting that in the Western world, it's always a game of cat and mouse, where you're asking the regulator for permission, or you're trying to change the law, or you're waiting for approval, and everything takes 6 months to a year. The minute you make some progress, a big bank shows up and they say, oh God, we don't want to compete with these guys, so let's shut the whole thing down. Like, for example, in New York City, I remember when BitLicense came out. I was contacted by some of the people who were creating it. They reached out to all the people in industry and they asked us for our advice of what they should do with BitLicense. We gave them a lot of advice, Losky and his cohorts, and they did the exact opposite of every single thing we recommended. And BitLicense effectively killed the entire crypto industry in New York. And what we saw was a mass relocation of almost every professional crypto firm that built cryptocurrencies or did cryptocurrency exchanges or these things to other jurisdictions. And Wyoming is now taking all of that business. So it's real difficult to innovate and be a cryptocurrency entrepreneur when your jurisdiction works against you. And because you're saying, well, I want to be there because the market is so large, but at some point, the market just is not worth it, no matter its scale. We actually see this in California. It's just wholesale. It's why HP left, Oracle left, Tesla left. California's a great economy, huge amount of people, so much going on, but it's just become so toxic to entrepreneurship and impossible to do business there that even despite the fact the market's so large, people are actually willing to leave it. And they say, just screw it, we can't do it anymore. They're moving to Texas and so forth. So unfortunately, the financial markets in the United States in particular are most regulated and most ossified. And regulation is mostly built to create consolidation of power, not for consumer benefit. So it's all about keeping the banks large. It's all about making sure that young startups don't occur and try to disrupt things. Like, for example, in Wyoming, they created a special bank charter, the special deposit companies, which are full reserve banks. The Federal Reserve tried to kill it. The federal government tried to kill it. The regulators in almost every state tried to kill it. It took 3 years of brutal bare knuckle fighting and almost like a Supreme Court fight to get to a point where these guys could actually get a Federal Reserve account, even though a state of Wyoming passed a law and gave them a bank charter. So it's like a case where even states are told to take a backseat to financial regulation because it's so pervasive and strong because they don't want competition. So as a cryptocurrency entrepreneur, it makes a lot more sense to focus on jurisdictions where the regulator is directly aligned with me, works with me, and creates demand and consumption for my products. And there's a natural reason why they want to consume that product that's non-speculative. It actually has real use and utility.
And interestingly enough, I think, and I've heard you talk about this before, the backbone of developed countries is institutional trust. And a lot of that, as we've seen over the last year, has diminished with the conspiratorial thinking and the rise of that. And I think a big aspect of the rise in price for Bitcoin and other cryptocurrencies is attached to almost like this mindset of having an insurance policy against a potentially corrupt Federal Reserve. Where do you see the direction of institutional trust in the Western world and where that's heading when it comes to conspiratorial versus just regular critical thinking?
So, Colin, how many scandals have you been through on Wall Street now? I mean, this is not a new thing.
Well, I think it isn't a new thing, and I think that financial activity is built on trust, and certainly the Western financial system has very much gone into regulation as a way to restore that trust, and so some of the legacy of the 2007, 2008 years was this ramp up in legislation to build that trust, and I think people are kind of seeing the back side of that equation right now, saying that maybe it's gone a little bit too far. I know and work with many regulators. Most of them are very well-meaning. They have very good intentions, and they're there to help ensure the trust in the system, that it works properly. And I think that when you look at what's happening with the Federal Reserve right now, they're responding to situations that they're not necessarily in control of. They may be making bad choices about the money supply, but I don't think that there's so I think some of that conspiracy thought is a bit out there, and I think, cryptos have very good answers for trust when you don't have strong central regulation. I think engaging with regulators is going to be an important challenge for all cryptocurrencies as well, because one of the, those regulations are there to make banks better to an extent, whether or not some of them were ill-informed. And when you're building a better bank, I mean, for an example, you're going to have to take on board some of the good things too, and so that I think engaging with regulators is going to be part of the strategy. And so to go back to that conspiracy thinking, I think that there's a lot of well-meaning people that can arrive at bad answers. It doesn't have to be a conspiracy. I don't think that the U.S. government is right now thinking, how do we devalue the currency or destroy the currency? They are, really everybody there is got the best efforts in mind. And it's a question of getting everybody to think through the implications of the decision. Sometimes it's very easy to make a quick decision where the long-term impact doesn't become known for maybe a decade. And I think we're seeing that with some of the financial regulation of the KYC and AML. It's very important, and being able to answer those questions. Those are legitimate concerns that need good answers. But some of the infrastructure around that's very hard. So it's a question of how do you restore trust or keep that trust, but maybe with a little bit lighter infrastructure around it.
Yeah, and there's this concept of cost of trust. I was born in 1987, and I'm a youngin'. And the year I was born, we had the Black-Scholes crisis, and then in the early 90s we had the S&L crisis, and then the 1990s, late 90s, we had the dot-com boom and bust. Then hey, we're doing great, right? And September 11th happens. Like, okay, well, and then Enron. I was like, oh God. So it led to Sarbanes-Oxley. We thought we were finally out of all this. Yay, coke and hookers for everybody. And then suddenly 2008 happens. And then, 2008, we're still living with this. And we see flare-ups of it. And the response to 2008, Colin is absolutely right, has been a huge amount of new regulation, like Consumer Financial Protection Agency, UK central bank, for example, said we're going to start focusing on microprudential policy. The FCA got much stronger and many more tools. And then there was also a discussion of how do we drain the dark pools and how do we create unified marketplaces and data reporting, because it's not the things we can see that hurt us. It's the things we can't see that explode silently that actually end up killing us in the marketplaces. Now, that trend has actually had a lot of victories over the last 10 years. In fact, the United States is just about to abandon anonymous companies, and they're just about to pass some legislation for that. And a lot of places that were famous for offshoring are no longer allowed to do that. They've actually eschewed this in the last 20 years, Switzerland in particular. So the problem is that at the same time, we live at an all-time low level of trust in institutions in general. And it doesn't matter the institution. The institution of voting, be the health industrial complex and vaccines, it can be the government with financial regulation. And there's just a perception that the little guy is getting fucked and the big guy always wins. And when you have a pandemic and the billionaire class gains a collective $1 trillion and everybody else gets collectively poorer, and the big companies got much larger and millions of small businesses are totally wiped out, and there's no way to give them relief, and there doesn't seem to be consistent information that comes in, it makes sense why people have no trust in institutions. What's refreshing about this for us is we live in the developing world as much as we do in the developed world. And so in the developing world, they don't have any institutional trust. They deal with civil wars all the time and tin pot dictators all the time and all these problems and corruption. So everybody's super skeptical. They never believe the news that they see. So they're already there, and they found out a way of living. And the point of cryptocurrencies is to restore institutional trust in the absence of it. So larger regulators are starting to realize that maybe blockchains are actually necessary, even in the Western world, to actually help restore institutional trust, because it's so badly diminished. And everything from e-voting to institutional trust for proper supply chain management. For example, a lot of people believe the vaccines that are coming out are contaminated with nanotechnology and these things. Now, they read it somewhere on the web. It's not true, but how do you verify that it isn't? And who is responsible for that? If you don't trust the people who watch and verify these things, then you're left in this like everything is just crazy. So it's a very complicated thing, and well-intended people are doing their best to try to resolve it, but the world has become too big and interconnected. It's become too complex, and really half measures are what we're seeing, and we're due for a completely new world structure. And that new world structure is going to have a lot of new technology in it, a lot of IoT, a lot of AI. It's going to have blockchain. It's going to have a very different way of thinking about doing things. And actually, it's going to be intrinsically transnational. So it means that sovereignty is going to erode a little bit. And the problem is that no one trusts that unless they know the rules can't be violated. So people don't trust the European Union, but they do trust Bitcoin. They're both the same in that they're transnational. The difference is that Bitcoin can't lie. It can't change its rules. And so people are much more inclined to have faith in systems like that than faith in systems that are very shadowy and asymmetrical and have no transparency and just kind of trust us and so forth. The other thing that bothers me is that regulators tend to have a revolving door into private industry. Like Ben Losky, for example, he created BitLicense, destroyed our industry in New York, and then he went and started making $600 an hour helping companies apply for BitLicense, and now he's on the board at Ripple. So we rewarded a politician who created profound damage to our industry, and his whole shtick now is monetizing a terrible regulation that he created. So when that happens, to me, it dissolves institutional trust. You know, the other thing is how Facebook was treated with Libra. This was another example of where people were attempting to innovate, and the entire US Senate collapsed down on them and said, how dare you, we'll crush you into dust. And now look at the consequences. Facebook, since that moment, is facing 48 antitrust lawsuits from 48.
That's so true. That's so true. It was just after that moment that happened.
And so
Wow.
what are they saying to Google and to Amazon and to Microsoft, these other companies? Don't rock the boat, or else we're going to break you up with Sherman antitrust. So, you know, how can I trust institutions when I see people trying to innovate for the benefit of the consumer, and those institutions then punish those firms regardless of their scale? And the same group of actors seem to win again and again and again and again. I read the emails from Goldman Sachs where the Goldman Sachs traders during 2008 knew they were selling toxic products to people and bragging about it to each other in emails. And then there was no consequences or recourse to that. JP Morgan Chase has had $19 billion in fines over the last 10 years. No consequences or recourse. They had RICO violations in some of their trading desks, where the same things that you go after the mafia with. No consequence to the CEO of the company. In fact, they considered the CEO, Jamie Dimon, for the Treasury Secretary position before they picked Janet Yellen for the Treasury Secretary position. So I'm a bit more snarky and skeptical in this respect, and I'm a bit more cynical in this respect. And I think nothing changes unless there's a strong financial incentive to change things, because power doesn't like to leave the hands of the people who have it. And that's why we focus a lot on the developing world, because there we're aligned with the people, and if we can get them into a new system, they'll get a lot wealthier. They get a lot wealthier, they'll outcompete the legacy system, and then the legacy system has to change or die, much like the newspapers. You know, they didn't really like the internet very much, but it's not like they had a choice in the matter. They either evolved, and like New York Times did, or they die like the Rocky Mountain News died, you know, because they weren't able to adapt to that new business model. And I'm very pessimistic that the regulator can actually deal with all these things. The incentives are wrong too. It's like regulators become politicians, and a lot of the regulatory outreach that they do is all about, how do I build a great career for myself? So you have the bureaucracy, but then you have the leadership of the bureaucracy, and the political animals influence policy in pervasive ways that are very counterproductive. For example, right now, the Treasury Secretary Mnuchin is debating whether to, and Coinbase brought this up, to force every single cryptocurrency user in America to connect their identity to wallets. So if you have a Ledger device or a Bitcoin wallet or whatever, it can no longer just be a naked wallet. You're going to have to connect an identity to it. Now, he's had senators, congressmen, he's had the CEO of Coinbase. Our entire industry has come down like a pack of hornets saying, don't do that. But he's not accountable to anybody. He's just about to leave office, and he could push a policy through with no recourse that could have pervasive and devastating effects. Why would he do this? Because who would the custodial accounts be? Financial institutions. So you can no longer be your own wallet. You're going to have to entrust that to a third-party service that has a bank license, probably Chase, you know, to actually run your wallet in the future. So this is the kind of stuff that just eats away at me. And I'm saying, guys, you're killing our industry by doing this. And they say, fuck you, we don't care. You know, it's we're big, you're not, you know, just deal with it. On the other hand, it's like 9/11 happened because of a financial component as much as it did because of people. So I understand why we have KYC and AML and anti-terrorist financing. And I feel better living in a world where evil regimes like North Korea don't get lots of money. And so it's very nice to say that we can cut them off. So there has to be balance in these types of systems, but the balance has to be built in the right way.
It almost seems like it's going to be. Did you want to say something, Colin? Sorry.
Well, I think that when we're looking at there's kind of a philosophical change in the way that people think about regulation, from just trusting institutions to taking personal responsibility. And I think that's a very empowering message for the crypto community, is the fact that you can personally verify. And it's not that there won't be experts, but you could, if you wanted to, get involved and double check these. And you know, certainly some of the scandals I often see at JP Morgan that Charles mentioned. I've worked at JP Morgan for over a decade and was involved in some of these. And I have a very different view on what happened than perhaps came out of the media, but there's no way for a personal or an individual to see that. And I think that one of the really empowering things about cryptocurrencies is that personal responsibility. You can check yourself, or an individual can check. You don't have to be part of the regulatory community to see this. You don't have to trust them. And I think one of the, I think it's really the financial system is based on trust. And the problem with institutions is the people change, and some people, when they're well run, they have good thinking. You can trust the people, and then the people change and maybe make decisions that aren't as good, maybe that aren't as visionary. But I think that change to a personal responsibility from kind of abdicating that to a collective is really important. And I think that's going to be one of the big messages that the crypto does bring in terms of changing the regulatory landscape, is how do you as an individual comply and make a difference with this? How can you do that personally? And I think KYC is a good example of how do you as an individual comply with KYC? And the answer is right now, you probably don't. You've got no ability to do it if you wanted to. You've kind of got to trust that these institutions are doing that. But when I'm paying somebody, I have no idea. And I think that having those built into a system that you can take personal responsibility for to make a difference is going to be really a big challenge for the crypto world going forward. An opportunity.
I love that.
Yeah, and looking on the other side of it, it's like in many cases, large institutions actually just take the fine and pay the fine because it's just the cost of doing business. It's like steroids with the NBA, with Major League Baseball. If you know that there's pervasive usage, if you don't do certain things, you're less competitive. And so you say, well, if that's the standard, we'll just do it, and then we'll pay a fine, negotiate something, and clear it through. And the problem is these are huge systems. I mean, there are millions of people, and even if 1% or 0.1% of your people are dishonest or bad, because they're in a position of power, they can have an outsized influence and create issues across the entire organization. And it's usually an issue of incentives more than anything else. If you create perverse financial incentives where you win at the expense of your customer, then you're always going to have bad outcomes. Like those Goldman Sachs traders, for example, they weren't paid based on how much money their client made. They were paid based on how much they could sell to somebody, regardless of whether that exploded in their face or not. If you were paid, after performance, it's right, you succeed together or you fail together. It's kind of like doctors. If you pay them to keep you healthy, they'll keep you healthy. If you pay them just to do procedures, it doesn't really matter if the outcome is positive or negative. And you tend to have a medical system that does too many procedures. So there's a lot of nuance in all these things. But to Colin's point, and I agree completely, the consumer doesn't see that nuance. They just see the headline and the scandal. And then there's this cat and mouse game. And I've dealt personally with the SEC. I've dealt with the CFTC. I've dealt with FinCEN. I know a lot of people there as well, as does our general counsel and others. And they're good people for the most part. They're easy to go along with and easy to know. There are some people who are blatant careerists who are very vicious, and they're just there to enhance their political standing. And they're always looking for a case. We see this a lot in the Southern District of Manhattan. That's a historical district that tends to elevate you to the governorship, or these things like Elliot Spitzer and other people. And actually, the show Billions really covers that pretty well. It's drama, but it's actually pretty true what that district looks like. So it's a nuanced thing. But my only grievance is that the regulators in many cases know that certain things that they're doing are hurting an industry and are anti-competitive, and yet they simply don't care. And then they leave and they go on and get cushy jobs at private law firms like Wilson Sonsini or Perkins Coie or something, and they make fabulous money basically trying to mitigate the damage they did when there was a regulator. And there's no long-term accountability for these types of things, and it deeply bothers me. So I think you can't solve it. I think the only way you're going to do it is build a parallel system, make the parallel system better than the legacy system, and then eventually the legacy system will transform itself naturally and organically to match the new system, or else it will die. And in both cases, you've got what you want, which is power pushed to the edges, you have transparency, and you have accountability. And to Colin's point, you can't do a lot of these things easily yourself, like KYC and these other things. And so the point of the system isn't that you have to do everything yourself. The point is, if you're going to have somebody do it on your behalf, you have a relationship with them, you trust them, and you chose them. It wasn't done on your behalf. and you don't have perverse financial incentives against you. Instead, it's like your lawyer, it's like your accountant, it's a service provider that you chose to be part of that transaction or that financial relationship to add value to your experience, whatever that might be.
So it seems like reestablishing institutional trust is really the core here. And we talked about what industries have shown the most interest in adoption for Cardano, but I want to kind of segue into what role do you believe Cardano can best serve when it comes to reestablishing institutional trust in a decentralized fashion? Of course, one of the questions Mandrick actually asks is a lot of people would assume it's, Cardano is just another form of currency, but there's likely a far bigger picture. Could you explain that?
Yeah, that's why I use the term financial operating system. And so I kind of look at a country like Ethiopia and I say, what's missing? And what is it going to take to modernize that country? 107 million people. There's about 107 million people in Japan. There's a little bit more in Japan, but productive-wise, they're a little bit younger in Ethiopia. So there's more working class there in Ethiopia. But Japan is fabulously wealthy and Ethiopia is not. Why? Because there are differences in systems. And so, you have to look at the delta between the systems of Japan and the systems of Ethiopia and say, well, why is Japan doing so well? And so the point of Cardano is to be batteries included, all the tools necessary to bridge that delta. And then once you install that, then you have an identity system and a property system and a payment system. And you have a system for managing contractual disputes and signing contracts. You have a governance system for corporate governance and these types of things. So all of that can live there. And if you get it right, you'll get mass adoption, and it's sustainable because you're running an economy with it. So there's millions of payments every day. There's all kinds, and it can be as simple as paying your utility bills. In fact, we bid on it. In corruption, we lost it, but we did bid on this deal where we wanted to actually be the settlement system for utility payments, electric and water payments in Addis Ababa, and we almost got the deal. But they have a terrible problem where the incumbent there, you have to pay at kiosks or you have to pay over the phone. And they have a situation where over 20% of the time the payment fails. And sometimes the consumer is not even told. So they thought they paid their power bill and then their power gets shut off. And they have to call with a friend's phone and be like, hey, my power's off. They wait on hold for 3 hours. They make a payment again. People promise them it's going to come back. And then 2 weeks later, it doesn't come back. It's a horrible system. And when you pay in kiosks, some people have to wait 3 hours in line. Wealthier people actually pay people to wait in line for them. When they get close to the end of the queue, they show up and they go and enter in all their stuff. So they said, hey, can we do this on a blockchain-based system? And so just think about how much productivity waste in a multi-million person city where it takes 3 hours for somebody to pay their electric bill, their plumbing bill, their water bill, to be able to solve that and do it on your cell phone, using your normal infrastructure. So that's kind of stuff that we imagine for Cardano. And it takes a long time to get it all done. It's like you measure things in years to decades. You don't look at things in weeks to months, but you don't have regressions. Once you have people there, there's a strong barrier to exit in that system. People aren't going to leave it and they keep building on it. And then what you've done is you've unlocked those consumers to the Western world. There's $5 trillion of wealth that exists in these markets. It's illiquid.
Wow.
You can't get to it. And so then you say, okay, well, now that we have this system for the first time ever, they have basically a micro bank account. For the first time ever, they can take loans. And I'll give you a very succinct example. Every year, the Agricultural Transformation Agency in Ethiopia, which deals with 15 million smallholder farmers, gives away all these fertilizer vouchers. And these vouchers that you basically use to go and plant crops, fertilize them, they grow, and then they repay the vouchers. The vouchers repayment rate is over 95%. And the interest rates are like 10 to 15%. So you have a microfinance situation where you have a sovereign guarantee of repayment if they don't repay, with a native 95% repayment rate and a 15% return. Can you imagine turning that into a financial product and collateralizing that and selling it on Wall Street? I mean, so you can't do that in America, but you could do that there. And if you have the right systems, you could slice up 10 million farmers and put them into a specialized financial structure. So when we talk about making liquidity for that wealth, that's exactly what I'm talking about. This is the next generation of financial products. And we can do that all on Cardano. And we can make Cardano interoperable with the legacy systems because you can embed in the transaction regulation, you can embed in the transaction KYC and AML, and special logic through smart contracts to comply with native regulations in the jurisdictions that they go into. So they can easily move into exchanges like NASDAQ or other such things. And so so that's the promise. Now that's like 5-10 years to get there, but it'll happen. And Wall Street is always looking. There's just too much money in the world. If you're the Norwegian Sovereign Wealth Fund, you have $1.5 trillion. How the fuck do you invest that? Everybody's like, give me a 9% return per year. But by the way, you can no longer invest in oil. Okay, all right. What else am I going to buy?
Just give the dividends as UBI to the people.
Yeah, exactly, right. And so you're just figuring out, like, how the hell do I move all that money? For BlackRock, it's like, how many trillions of dollars do these guys have? So there's just not that much investable good stuff with great returns, and so they need new asset classes all the time, which is why we're seeing institutional movement into crypto. But that's just the beginning. I mean, speculation of the base tokens should be boring. The financial products built on these platforms are the things that are going to be really exciting, especially when you talk about exotic assets like securitizing intellectual property. A great example would be Moderna. Moderna, Novavax, all these other companies are IP companies. They went and did all this great research for a long time, no profit, no products in market, but there's always potential. And then a black swan event happens, and now they're like making $60 billion on selling vaccines across the whole world. Huzzah. And now because of that money, they'll be the Tesla of vaccines, and they'll be doing cancer vaccines and all these other things. It'll be great. Well, what if you could securitize the intellectual property, and then you could sell the rights to future revenue if these things were successful? It should just selling wholesale equity. So examples of exotic, very granular securities that you can construct when you have a cryptocurrency, and it's very easy to handle dividends, and you don't need central exchanges to clear them, and you can always recall them, and you can enforce clawbacks and all these things. You can do all that stuff. It's really hard to do that in the traditional equity markets, but this is the kind of innovation we're going to see in Africa. Once those products have standardized, then we'll see it in the Western markets, and it'll create trillions of dollars of new wealth.
So I want to talk about the recent acquisition of Legends of Valor that you made, the video game that you actually recently acquired, and potentially incorporating non-fungible coins into that. But before, I do have one last Cardano question from Crypto Secret Circle. It says, will Cardano work with Litecoin? But I don't think that's the real question. I think this second part is the real question. You mentioned the second layer scaling solutions that you just are launching tomorrow, I believe, with being able to take any Ethereum app and putting on Cardano. What type of second layer scaling solutions are there current? What other type of second layer scaling solutions do you have planned for Cardano?
Yeah, so you have to have the right platform. You have to have the right engine. And once you have that, then you can build lots on top of that and do it really easy. So we had to do 3 really complicated things at the same time. We had to figure out the right consensus protocol, we had to figure out the right network model, and we had to figure out the right accounting system. Once we had those 3 things figured out, and it took us 5 years to do that, 12 papers and a lot of hard work, and some of which Colin did and other people did, because it's not just science work, it's economic work. Then you're saying, okay, can you build stuff on top of that that allows you to do stuff off-chain, roll-ups and state channels and payment channels and these types of things? And so in parallel, we built a protocol called Hydra, which we're turning on next year. And that's all about microtransactions. That's a truly distributed system, not a replicated system. So just on the base layer, Cardano has a path to get to about 1,000 TPS. It's just really all you need, for any large scale. So even when you look at Visa, MasterCard, these other things, they tend to, outside of their spikes, they tend to live at that baseline. So you only need that. And then what you do is you have these Hydra channels that the stake pool operators can run. And each channel has a throughput of 1,000 TPS. And that's independent of the other channels. So you have 1,000 stake pool operators, 1,000 TPS each. That's 1 million TPS that you can get with a system like that. You're running these things on chain. But if you have the right accounting model, you have the right network stack, the right consensus system, it's very easy to seamlessly move on chain and off chain and route things properly. So when we talk scalability, that's really where it's at. The other thing is, once you have that network in place, it's very easy to start talking about cross-chain transactions. And then you use that routing mechanism to basically create wrapped assets. So you can send wrapped Litecoin into Cardano, wrapped Bitcoin into Cardano. And then if you have a DEX, do high throughput DEXs with that. And then suddenly people can trade all these things. And you actually see DEXs take a big chunk out of exchanges. And by the way, that's an example where regulatory failures are creating necessity for DEXs. People aren't creating DEXs because DEXs are great. They're slower, higher fees, and less liquidity and bigger bid-ask spread. The reason why they're pursuing DEXs is because they're honest. And people are very concerned about exchanges. They get hacked all the time. There's evidence of front running. There's evidence of bot manipulation. These things exist. And so in the absence of good regulation, we actually have to solve that with blockchain efforts. So that's what we're doing on the scalability side. I think that is probably the fastest, quickest, easiest, dirtiest way making Ouroboros better and faster, and then creating Hydra of getting all our needs for 10 to 100 million users. Then what we'll need to do in the long term is we're going to need to invest very heavily in recursive snarks, and we're going to need to invest very heavily in making data in the system an economic agent, meaning instead of it being persistent, it has to pay rent to stick around, and if it doesn't, it gets pruned out through some meaningful way. Because then you can always keep your blockchain at a reasonable level alongside decentralized storage, so that you can have a petabyte scale system. So that technology is evolving very quickly. Dan Bonnet recently published a paper called Halo Infinite, came out just a few days ago. Halo is like the brand standard in recursive snarks. And I think within 24 to 36 months, those will be market ready. And those are miracles. You have full node security with a light client. No matter how big the system gets, you only have a few kilobytes to a few megabytes of data, and you can interact with a multi-petabyte system. But you still need a network stack that can scale with it, and you still need to be able to store all that data. So you need a better way of handling it. So we're about 5 years out for all those things to come. But I think we have a great plan for 2023, 2024 to get to 10 to 100 million with just Hydra and the base layer.
And with Cardano being one of the most committed projects on GitHub, I think that's completely accomplishable, and it obviously shows why. And so we will wrap up here in just a second. I know your time is valuable. Let's just talk quickly about a passion project of yours to wrap this up. You bought Legends of Valor. Can you tell me about your game company, what you plan to do with that, and how do you see the future of gaming and NFCs incorporated into games?
Movies are kind of on the way out. I was in a movies theater last year before the great pandemic. It's like we'll all tell our children one day what movie theaters were. It's kind of like silent films, right? And I saw this woman to the left of me, and she was on her cell phone, and the woman to the right of me, she was on her cell phone. I was like, "Girls, you're here at a movie. Why are you on your?" But the point of that story is that attention is at an all-time low. It's the most precious resource. No one pays any attention. I can't tell you how many times I'm in meetings with people and I catch them like through the reflection of their glasses, reading their Facebook page while talking to me or things like this. I can see you in your glasses. I know you're doing it, right? So attention is very scarce. And so video games are one of the very few mediums that exist where people are completely committed. I mean, you have people that'll spend hours and hours and hours completely engaged and enthralled, and sometimes forego food and sex to play a game. And you're like, wow, okay, that is a commitment. So that's a great medium to tell stories. And there's so much more power in that medium, especially now that graphics have caught up. Like God of War, for example, it's a AAA game, but it's just as good as any movie. And people like really fell in love with Kratos and that entire story and so forth. So I always wanted to be a game developer. I always wanted to have something there. And there was a lot of games I played in the 80s and 90s that had so much raw potential, but were encumbered by the times. Legends of Valor, for example, was the inspiration for the Elder Scrolls series. So the guys who created Elder Scrolls, they created Skyrim and all these other great titles, they played Legends of Valor first. And the problem was that Legends of Valor ran out of money. The studio that created it, they didn't have enough money to finish the game, so they just kind of released a half-baked thing. And so there was all this missing stuff. And when I played it as a kid, I didn't know it didn't have an ending. And so I played it for years and years and years trying to win the game. And then I found out only as a teenager that the game had no ending. So I made a commitment that at some point I'd finish the game. And so now I'm fabulously wealthy. And so I said, fuck it, I'll just do it. So I bought all the intellectual property for Legends of Valor. And I'm setting up a game studio in Wyoming. I'll hire 10 to 15 people there and probably create a parallel office in Ethiopia. And, we'll redo Legends of Valor as a two-step process. First, we'll do an enhanced edition similar to what Beamdog Studios did with Baldur's Gate and get it to a playable state on modern systems with massive enhancements to the gameplay mechanics because they were so primitive. And then I'll do a complete remake of the game. And I have hundreds of pages of notes that I wrote throughout the years on airplanes and as a child of things I wanted to do there. And I'll go ahead and do all of that. And then I'll go do a bunch of other passion projects. Like I'd love to buy the Gold Box engine and redo all those Gold Box games. There were 13 of them. And, the license will probably be pretty cheap these days. And there's tons of things you can renovate. And my point about storytelling, because that medium has evolved so much, it's one of the last places where you really can talk about things, like the nature of good and evil or, Pyrrhic victories or other philosophical concepts. There's a great YouTube channel, for example, called Wisecrack, that actually talks about these things all the time for various television shows like Rick and Morty or other things. Like you hear like Rick and Morty analyzed from Albert Camus, absurdist viewpoint. And so what's so cool is that you can take these deep philosophical concepts and you can actually embed them into a video game and you tell storytelling. For example, like the emergence of AI, what does that do? Or climate change, what is that going to do? And you don't just tell people, you show people, they experience it. You can put them in a post-apocalyptic setting. You can put them in a setting where institutional trust has become a dystopia. I mean, look at Cyberpunk 2077, right? It's the latest game that came out. It's like everybody's transhumanist now, right? Because that game's out. They're all thinking the same thing that happened with Deus Ex. So it'll be a passion project. It'll take a few years to spool out. Now, you asked a specific blockchain question. Where does the blockchain component? There's really two dimensions where game development is greatly enhanced with blockchain. One is DRM. You can create licenses on a blockchain and you can trade them. And so you have to have a token present to be able to activate the game. What's really exciting about that is you create a notion of used software. So when I was a kid, you went to Media Play or CompUSA or any of these now out of business vendors, and you would buy a CD. And then when you were done with the game, you'd sell it to your friend. You'd be like, hey, I'll sell you the game for $5, right? You can't do that anymore because everything's digital distribution. Well, if you have a token associated with a software license, then what you can do is actually resell it on a marketplace as used software, and actually you can continue having a royalty line to the IP owner. So even though people are reselling used games that are out there, I can actually make it a finite set of licenses. So instead of selling to anybody, you can maybe only sell 10,000 copies, and you allow a used market, and perhaps the used games sell for more than the main game. So you can create artificial digital scarcity, and that's a really cool thing that has never been explored. The other thing is that in-game items, World of Warcraft showed this, and other things where people actually pay real money for WoW Gold or pay real money for items in Diablo 3 and Diablo 2 and these types of things. So you can tokenize those things and actually sell them on crypto exchanges and say, okay, this sword is now represented by this non-fungible asset, and there's only one of them in the entire game world, and you can enforce that. Requires a little bit more sophistication of the hood. You usually have to involve trusted hardware, but that's fine. That's embedded in every Intel, ARM, and AMD processor at this point. So it's definitely easy to do that.
Well, it's exciting to know that Legends of Valor will finally have an end. And I want to end this interview here with you, Charles and Colin. I really appreciate your time. The whole crypto community, I can tell you right now, is extremely excited about the developments going on with Cardano, Ethereum, and every other project, of course. It's bringing a lot of enthusiasm and hope to a lot of people. And so I want to thank you for your time once again. And until next time, if you have any final words, go ahead.
Colin, why don't you take us out?
I'm going to put a proposal on building your auction house for you.
That'll be a lot of fun. Yeah. Actually, there's some people who made a fabulous amount of money selling digital gold. Like I think the CEO of EOS, Brendan, actually that's where he got started. He was in the WoW gold business back in the day in Hong Kong. And it would be really cool if people can make their entire living selling things. Like you see this in EVE Online and these other games that have like real life economies. There's a whole shadow economy of selling things, and to be able to have non-fungible assets in your game world or rare assets in your game world and actually having a whole marketplace for that, and there's actual real life trading occurring. It works really well for cryptocurrencies. It's just a natural use case and a natural extension, and it's just another way for independent game developers to monetize their products. And crowdfunding is another area. Pillars of Eternity and Pathfinder, for example, both of them raised millions of dollars through Kickstarter and Indiegogo. So that's just like the tip of the iceberg. It would be really cool to create a cryptocurrency crowdfunding platform for video games. And there's not any regulatory problem. You're selling a clear product and there's a clear use and you're buying a software license and so forth. So I think that project financing is going to be much easier, especially given that there's all these tools we're developing for proper use of funds. And you can apply the same things that people are trying to apply for next generation ICOs towards project capital financing for video game development. Because when you're talking about a AAA game, I mean, it's $20 million to $50 million to bring a AAA game to market if you want to be cross-platform. And even an indie game, you're looking at $1 to $2 million. Like Hellblade, for example, was very cheap, and they brought it to market for $2 million.
Wonderful. Well, thank you for your contribution to the cryptocurrency and the world community of decentralized finance, Charles and Colin. It was a pleasure talking to you guys today.
Thank you so much. It was so much fun. It's 2 a.m. here, so I'm going to get some sleep.
All right.